Good day. On behalf of Miles Franklin, I'm Drew Mason, and we're happy to have the occasion to bring to you Joe Foster, veteran portfolio manager of the Van Eck Gold Fund. Joe, thanks for taking time from your schedule to speak with us today. Perhaps we could begin by asking you about the current gold cycle. You've been a gold observer for some time now. How does this cycle compare with cycles you've seen in the past?
Well, we're in the midst of a secular bull market in gold, and it's one of these markets that only comes around once every, say, 30 or 40 years. You know, the last one was in the 70s. Prior to that, you have to go back to the 30s and the Great Depression to find a bull market of this magnitude and scope. So yeah, this is a once in a career move in the gold market. And I think, as far as I can tell, with everything that the way the economy is, the things that the governments are doing to try to stimulate the economy and stave off crises, all these actions are serving to prolong this gold market. As far as I can tell, it's been going on for almost 10 years now. It could go on for another 10 years for all we know.
What are the holdings that you find are most attractive at this point?
Oh, we've actually, throughout this bull market, we've gravitated towards companies that, number one, can provide some sort of growth, grow their production, and more specifically, organic growth, companies that can, discover new deposits and bring them into production. So to find those types of companies, we have a higher weighting in what we call the mid-tier companies, where we find good managements that can add accretive growth. And also we've got a generous allocation to the juniors, which would be the emerging companies that are developing properties that are going to be the up-and-coming producers.
We see from the filings that you own the GLD. What are your thoughts about owning the physical? Is it just a barbarous relic?
Barbarous relic. It's the ultimate form of currency, so it definitely deserves a place in everybody's portfolio. When you're looking at the gold space, I encourage diversification. So I think you should own the GLD, the physical gold, some gold stocks. Better to have a diversified portfolio within the gold space for sure.
You had been calling for gold to consolidate. We're halfway through the second quarter of 2010. Could you update us with your thoughts on that topic?
Well, we moved to all-time highs in December. We had a bit of a correction, then we hit new highs again just I guess this month or last month. And usually the gold market tends to consolidate in the summer months. So it wouldn't surprise me to see some consolidation, a pullback, who knows where, 1100 or maybe even dip below that level as we move through the summer months. And then following some consolidation, because the market I think is overbought right now. So following that consolidation, I think the bull market will get back on track, and I think hopefully this will give us a good buying opportunity, really.
So far, the move we've seen in gold this cycle has replicated what we saw in 1970 to 74. We then saw about a 2-year pause and pullback in the metal. Do you think that's the type of duration consolidation we're looking at here? Think it'll be shorter, or how do you view it at this juncture?
The consolidations last, if you look how this bull market has gone, I mean, we get a nice advance. It usually occurs towards the end of the year and into the new year, and then we'll go through a consolidation that'll last anywhere from 6 months to about 18 months, and 2 years wouldn't be out of the question for a consolidation. So I think that's the normal course of this market. You get we're constantly getting new buyers coming into the gold space. So as we get a new wave of buyers, of that buying becomes saturated or satiated, then we go into a consolidation. And with everything going on in the macro economy, other events occur that bring in another wave of buyers, and we get another move in the gold market, and it moves in steps like that, and I expect that to continue.
This may be tough for you to answer as a portfolio manager, but what would you sense is the approximate percent of the American public that has a meaningful amount of gold in their own accounts?
In terms of percentages, I'm just guessing anecdotally. I would think would be relatively low, especially if you compared it to the gold ownership in the 80s or past big bull markets in gold. I think it would be extremely low. No data to back that up, but that's my sense. I mean, you get it's more. I think there are more people selling jewelry now than buying coins. So that's sort of the dynamic at the moment.
If that's the case, how can you justify the move that we've seen in the underlying?
Recently, it's coming out of Europe. I mean, people in Germany, Switzerland, many of the European countries are genuinely fearful for their currency in the euro and some sort of a collapse in their economic system. So European buying has been the big driver in this move.
You've mentioned currency twice now. Most Americans still don't think of gold as a currency. They think of it as a commodity with less than usual intrinsic value. What's your view on that?
Gold is the ultimate form of currency. Gold has a long history. It goes back to the beginning of mankind, basically, beginning of civilization, I should say. It's found across all cultures. It's found all over the world. It's used as a store of value and a currency all over the world. Always has been, and I think it always will be.
When you talk to your companies, what is the sense that you have as to their fully allocated cost of capital in getting gold from the ground?
I would put it up around $800-900 an ounce, somewhere in that ballpark. So if we had a severe correction where the gold price dipped below, say $900 an ounce, it would put a lot of producers in a tough spot.
Is that simply because CapEx has been starved?
Capital's been going up significantly. It's more a function of prospecting or exploring for gold deposits. The big prolific gold fields are in their declining years. You're talking about Nevada, Western Australia, and South Africa. All of those are the most prolific gold fields in the world. They're all in decline, and we haven't found big prolific areas like that to replace those. So so to me it's in permanent decline.
You think about the recent headlines that we saw in Australia and the potentially large changes to the tax rates that will be imposed upon the miners. What's your back of the envelope calculation about how that could impact the cost of capital for the mining companies?
Oh yes, the draconian tax that's been announced in Australia will increase cost fairly dramatically in Australia. We just hope that it doesn't. We don't hope that other governments don't follow in Australia's footsteps along these lines.
How about the other side of the ledger? What do you see happening with demand?
Well, investment demand drives gold bull markets, and jewelry demand comes and goes with the gold price, but as long as we have these economic issues, currency issues, debt issues around the world, investment demand will be the big driver for gold.
What do you think about the increased retail demand we saw out of China post the changes to the rules there? Do you think that is sustainable?
As long as the Chinese economy keeps moving and growing as it has, I think their gold consumption will grow as well. So yeah, China is on the consumption side, aside from investment demand, just jewelry demand. China is the one bright spot in that segment.
Well, thank you, Joe. We appreciate your thoughts and your time today. Look forward to catching up with you soon.